Thanks, Rennie, for the introduction. I will start by giving a brief overview of what we'll be discussing today. We will start with the current small and medium business lending market, then move on to advantages platform tech companies have in this market and outline their lending business models. Finally, we will briefly discuss what's next to come in the space. Small and medium-sized businesses need money to expand operations, but it is often difficult for these small organizations to raise capital. According to the Fed in 2016, 52% of businesses 5 years or younger applied for external funding. Of those applicants, 69% received less capital than they applied to borrow. Companies are being underfunded for two reasons. Most prominently, businesses have insufficient credit history. This means that businesses have not built up credit scores and as a result must rely on business owners' personal credit scores to raise capital. The second reason for underfunding may actually be because business owners lack the ability to forecast cash flows. This may lead to an overestimation of a business's required leverage and result in partial funding. We will now walk through the four main players providing leverage to SMBs. While credit cards provide great benefits, they are merely short-term revolvers designed to be paid off every month. If credit cards are not paid off monthly, businesses expose themselves to the dangers of compounding interest. Banks' lending platforms are still built on legacy tech, which leads to inefficiencies and days between application and funding. Alternative lenders provide borrowers efficient and user-friendly methods of raising capital. Some lending startups like Cabbage and Clearbank have become less reliant on credit scores and more reliant on real business metrics for their underwriting methods, allowing more businesses to raise capital. These companies are not considered platform lenders because interest is their main source of revenue, and this is their only line of business. This brings us to the platform tech companies. These five companies, PayPal, Intuit, Amazon, Square, and Shopify, have reinvented and redesigned SMB lending to better fit today's online environment. So what separates platform tech lenders from their competition? In this webinar, we will analyze how the five tech platform companies, Amazon, Square, PayPal, Intuit QuickBooks, and Shopify, are utilizing three major long-term advantages to quietly disrupt small business lending. First, private data fueling their underwriting algorithms. With billions of private internal data points about merchants' business operations, platform companies are able to use machine learning to study past trends and train algorithms on how to predict future creditworthiness. Second, lending with aligned interests. Since platform companies rely on third-party merchants to fuel their revenues, the success of the two parties is interwoven. Therefore, platforms are providing funds to merchants with the goal of spurring third-party growth on their platforms. And lastly, business models allow platforms to overlook interest revenue or potential losses. Because the long-term goal of platform companies is to grow their main business units, for example, Amazon's marketplace, they're able to focus on long-term goals and look past interest revenue and potential losses. Each platform business model produces different types of useful credit data. Generally speaking, the type of private data collected originates from one of three categories: marketplaces, payments, and accounting software. Because platform companies are the sole owner of their underwriting models and its inputs, they're able to continuously alter and improve these models as credit cycles change, therefore making private data more valuable than credit scores. As the five companies continue to grow, they're expanding the depth of their private merchant data and beginning to straddle these categories. For example, Amazon Pay gives Amazon payment data in addition to its marketplace data. Another example is Square's core business is payments, but as they continue to expand into new marketplaces such as e-commerce and restaurants, they're collecting new data sets. Marketplaces offer up valuable data on third-party merchants, including sales, conversion rates, checkout metrics, and merchant ratings. To get even more granular, in the case of Amazon, if a merchant uses Amazon's fulfillment center, Amazon is able to track data like average inventory and days for inventory to turnover. Companies that facilitate payments are able to collect and analyze payment volume, frequency, and history. Accounting software like Intuit QuickBooks captures very valuable information essential to credit. QuickBooks is able to assess a business's short and long-term assets, outstanding debt, and as a result calculate various ratios like debt to income. We will now analyze PayPal's credit model to further explain how credit models are used to rate potential borrowers. PayPal is the only company of the 5 to disclose an in-depth look at their internal credit model. In PayPal's case, their underwriting model, PayPal's credit model, is on a scale between 350 and 750. Scores above 525 are generally expected to receive funding, while scores above 610 are viewed as very good scores. Primary drivers of the model include merchants' annual payment volume and payment processing history with PayPal, prior repayment history with PayPal's working capital product, and other measures. As of December 31st, 2017, 64% of PayPal's business receivables were rated higher than 610, and only 16% were less than 525. Scores are constantly being refreshed even after the capital is lent out, so PayPal can continuously monitor its risk. In total, only 7% of receivables remain outstanding for greater than 90 days after expected repayment. While these loans are not collateralized in the traditional sense, they are collateralized against any future PayPal sales. I will go more in depth into this shortly. Using private data to fuel underwriting techniques has given platform lenders real prediction power. Amazon, Square, and Shopify's business lending programs are by invitation only, which means their underwriting algorithms can not only predict creditworthiness, but can also forecast cash flows. Now that we have a good understanding of why platform lenders have an advantage over competitors, let's dig into their business models and loan mechanics. Platform lenders use 2 different revenue models, fixed fee and interest. PayPal, Square, and Shopify utilize the fixed fee model, while Amazon and QuickBooks employ the more traditional interest model. With that said, these companies have made lending profits a secondary focus, letting them simplify their business models, allowing more businesses to participate. Fueled by PayPal's risk model, discussed earlier, PayPal's working capital is only available to merchants who utilize PayPal services. Upon application approval, merchants receive funds from PayPal in about 5 minutes. The following day, automatic repayment of this loan begins by deducting a preset percentage of revenue collected through PayPal on a daily basis. Repayment is flexible as it is designed to match a merchant's cash flow. For example, if a merchant has a day with $0 in sales, there will be $0 repaid of the loan. Here is a sample loan calculator for PayPal. As you can see, the lower the percent of sales used to repay the loan, the higher the one-time fee is. This is determined by the business's annual sales and the amount they would like to borrow. PayPal loans have no other fees or periodic interest other than the one-time fee. This one-time fee is spread across each daily repayment. What does PayPal do with the credit risk? After making the loan, PayPal looks to sell their risk off their books to investors. Currently, PayPal looks to hold about 20% of the risk on their books, while the other 80% is sold to investors at any point throughout the loan's maturity. Square Capital offers fixed-fee, invitation-only loans. Like PayPal, these loans are paid back automatically through card sales processed on Square's terminals. Upon accepting the offer from Square, merchants can choose to pay back the loan using 9, 11, or 13% of daily card sales. All credit decisions are made strictly based on Square Capital's underwriting model. Factors included in this model are processing volume, recent payments, history with Square, activity levels, customer mix, and overall health of the business. Over the past 2 years, Square has partnered with Upserve, a restaurant management platform, and BigCommerce, which helps small medium businesses build online stores. Together, they're helping grow Square Capital and lending to the partnered clients. By bringing Square Capital to non-Square merchants, the company can gain access to more merchant data and potentially leverage Square Capital to bring more merchants into Square's core payment business. It appears these partnerships actually foreshadow Square's recent strategic moves. In 2018, Square acquired Weebly, an online platform that allows anyone to create an e-commerce store, and also expanded Square's brand and POS systems into restaurants. This will allow Square Capital to continue expanding. Currently, Square Capital sells business loans from its balance sheet to investors. According to their CFO, Sarah Fryer, this helps continue to fuel the growth of the business while helping manage risk at the same time, although this may not always be the case. Last September, Square applied for a bank license under the name Square Financial Services, which would offer loans to small businesses. In other words, rather than selling the debt to investors, Square would keep the debt on its bank's balance sheet. Shopify's invite-only SMB lending program is slightly different than the rest of the platform lenders. Shopify provides capital to merchants through a merchant cash advance. Although not technically a loan, the mechanics look very similar to PayPal and Square's lending processes. Shopify provides funds upfront in a transaction where they buy future receivables at a discount. The merchant then remits daily accounts receivables to pay Shopify back. Here's an example of a sample merchant's remittance schedule. Each day, 7% of all receivables are remitted back to Shopify until the advance is fully paid back. Amazon Lending is a secret program that does not have a public-facing website. Amazon's invite-only lending program creates a true symbiotic relationship with platform merchants. All borrowed funds are required to be spent on Amazon's marketplace inventory, and thus lending helps sustain Amazon's overall inventory levels. Amazon helps merchants fuel sales growth by enabling the sale of inventory that they previously would not have been able to afford. Debt is automatically repaid through a seller's Amazon account on a monthly basis. It is believed that Amazon charges anywhere from 6 to 16% APR. Amazon loans are capped at a term of 12 months. Recently, Amazon partnered with Bank of America to sponsor loans to merchants. Even with the Bank of America deal, Amazon lending has slowed. After almost doubling to $661 million in 2016, outstanding loans just barely increased last year to $692 million. Intuit QuickBooks has the most traditional lending business model of all the platform lenders, but it hopes to be the most impactful. Unlike the other platform companies whose end goal is to grow their main business unit, QuickBooks is attempting to create an all-in-one credit model. The company does a soft pull on the applicant's personal credit and a formal pull on the company's business credit. QuickBooks hopes that the combination of internal data and credit checks will help the company create a next-gen underwriting algorithm. QuickBooks loans are either 3 or 6 month term loans and range from 10 to 26% APR. These loans require a personal credit score of at least 580. QuickBooks business loans are personally guaranteed, meaning if your business is unable to cover the debt, QuickBooks will come after you personally. QuickBooks has created an underwriting system using both traditional and internal data to be able to lend to a wider variety of businesses. According to Brad Smith, Intuit's CEO, those that are getting loans through QuickBooks Capital, 60% of them were considered unlendable by other financial lenders up till this point. And most importantly, they like the economics of the business. Okay, let's do a quick recap. The 5 platform lenders operate with 3 different lending models: fixed fee, merchant cash advance, and interest. While all the companies collect payments in a slightly different manner, it is important to note that all of it is done automatically. Also, PayPal, Square, Shopify, and Amazon are lending with aligned interests to grow their platforms by growing third-party merchants. Intuit appears to be providing capital to SMBs for slightly different reasons. While they are growing their name brand, their main goal is to create an underwriting algorithm to be able to provide capital to previously underfunded businesses. What are other platform tech companies doing? Other platforms are relying on strategic partnerships to provide merchants loans and are essentially outsourcing merchant lending. While these companies are helping merchants grow and therefore growing their marketplaces, they are not creating their own underwriting systems. So what's next for tech giants and lending? Expect to see more large companies utilizing their private data to create their own underwriting algorithms. Also, tech companies will ramp up their personal lending and point-of-sale lending offerings. This year, Facebook received a patent for what seems to be an underwriting system for online advertisers. This patent outlines the framework of a system that would allocate more advertising accounts or credits to parties that are unlikely to default on their payments, while limiting accounts and credits for advertisers that are more likely to default. Airbnb recently started a program called Airbnb Select. One aspect of this program is that it offers a cash advance to bring houses up to the Airbnb Select standard if they do not already meet this standard. Expect this category of platform lenders to continue to grow as tech companies learn how to turn private data into credit data. As we think about what is next to come, it appears POS lending, or point-of-sale lending, is the next forefront to be disrupted by tech giants. Right now, PayPal offers a digital line of credit with 6 months deferred interest for all purchases above $99. PayPal CEO Dan Schulman went as far as to say, in 20 years, he doesn't believe credit cards will exist. Square recently created a point-of-sale lending system akin to Affirm loans, where customers can get a simple interest loan directly at the Square terminal. Apple recently announced a partnership with Goldman Sachs that will start with traditional credit cards, but this may just be the beginning of the relationship. It is rumored that the two are looking to create a 0% interest loan for all Apple products. All these companies have slightly different private data on consumers, and it'll be interesting to see how they utilize it going forward. Okay, if you have any questions, please just send them our way at this time. Okay, the first question. If Square does attain a banking license, what other products would they offer? So right now it is believed that Square Financial Services, which is what they would call the bank, would only serve merchants, allowing them to take deposits and use those deposits to make loans. It is believed that Square Cash would remain a separate entity. Okay, the next question. Overall, do you think SMBs benefit from the system of platform lending? I do think so for sure. I believe platform lenders provide 3 benefits to business owners. First, invitation-only loans allow algorithms to predict cash flows and help businesses manage expenses. Secondly, I think the transparency of a fixed fee model allows a business owner an opportunity to plan ahead. And lastly, I believe repayment methods are more aligned with small business cash flows. So it takes less of a toll on the business, giving money back slowly over time as a percentage of sales rather than in lump sums. Okay, and a third question. What is the maximum loan amount each service offers? So PayPal offers 30%, allows businesses to take out 30% of annual payments serviced by PayPal. If it is your first loan, though, they cap it at $97,000. Square ranges between $500 and $100,000, but the average loan size there is only $6,000. Shopify between $400 and $500,000. Amazon between $1,000 and $750,000, and Intuit QuickBooks between $1,000 and $35,000. If you'd like more information on this webinar, please go to our platform where we have already published a post about tech companies getting into small business lending. If you have any further questions, feel free to email us or reach out on Twitter. My information is emmabramski@cbinsights.com, and on Twitter, emmabramski22. Thanks everyone for joining today.